In this conversation, we're joined by our good friend Pankaj Balani, CEO of Delta Exchange. If you've watched our videos before, you know that Delta is a cryptocurrency derivatives exchange and a sponsor of our channel. Pankaj brings a wealth of derivatives knowledge from his time on UBS's trading desk in Hong Kong. Derivative exchange mechanics have received a lot of attention recently. BtMEX, as the longest-running derivatives exchange in the space, has often been the center of this criticism. But last week it was Binance's turn, with users complaining about being prematurely closed out of profitable positions, and their insurance fund reportedly taking a $13 million hit, all while other exchanges look to have suffered little to no impact. In this conversation, we dive deep into a number of topics around derivative exchange mechanics, including how exchanges use auto deleveraging and their insurance funds. If you find this content useful, don't forget to like, subscribe, and share it. It really helps us get on the right side of YouTube's algorithms. Here today with Pankaj Balani, the CEO of Delta Exchange, an up-and-coming crypto derivatives exchange. So we've obviously had quite a bit of volatility in the market over the last couple of days. We had a 20% downswing on Bitcoin on Sunday. And a lot of people in the market are wondering why that happened. It was another one of these really sharp price moves. And there's a lot of talk about exchange outages. Coinbase went down for a bit. Binance went down for a bit. And a lot of people are talking about auto deleveraging. So that's one of the topics I want to jump into right off the bat is what is auto deleveraging and why do exchanges do that?
And is it a bad thing?
Sure. So yes, there's been a lot of chat about auto deleveraging, and it happens every time. Every time there's a sharp move in market, basically we hear about liquidations, we hear about insurance fund, we hear about ADLs, and a lot of people, like you said, don't understand it. It just sounds like okay, something is bad, and that caused the price to go down. Actually, that's not the case. A lot of these are procedures to make sure that there is a sanity that is maintained at exchanges. Now, before getting into ADL, let's understand how derivatives work, or any margin trading, or any any leverage trading. How does it work? There's a party that is long, and then there's a party that is short. The amount of open long positions should be equal to the amount of short positions. Okay, that has to be true at any point in time. For an exchange, assuming that the exchange has zero positions, then total number of buyers should be equal to total number of sellers, or rather total number of open positions on the long side should be equal to total number of open positions on the short side. That is the basic equation you have to follow. Otherwise, there is an imbalance. And this is called open interest. So open interest also, people get confused at times. That is it long open interest or short open interest? There's nothing like long or short open interest. This is basically the net open interest. How many long and how many short. Net is always zero, but what is the size on either side?
Yeah.
Now, let's say there are 100 million. I'm just taking that number. 100 million is not important here. It's just for example. Let's say there are 100 million longs and 100 million shorts. Now, market goes down. And longs were at different leverage. Some were at 10x leverage, some were at 100x leverage, some were at 50x leverage, whatever those numbers were, right? Now, some of these people got liquidated. Okay, so about 10% of these, or 10 millions of these got liquidated, which means that their positions will be taken to open order book, and whatever orders are there will have to be matched against those positions. Now, imagine a scenario that so what is the price for these liquidations, right? What is the price at which these liquidations happen? So every trader contributes some maintenance margin to a position. Okay. Now, there's a liquidation price and there's a bankruptcy price. The difference between these two is basically the maintenance margin. Okay. Now, it's not a literal sense difference. In a literal sense, you can't subtract these two and get a number, and that is maintenance margin. But the idea is when price moves from point A to point B, liquidation price to bankruptcy price, the loss or the reduction in the value of the position is the maintenance margin. So whenever liquidation is triggered, liquidation price is breached, and then the system takes over the position from the trader who is getting liquidated and goes and tries to sell that position or tries to buy that position at the bankruptcy price. Okay. All this happens at the max leverage. So Bitcoin contract max leverage is 100%. So that number is 0.5%. So if you were getting liquidated, system will take over your position. There's still 0.5% equity left in it. It will try to close that position at a within 0.5% range. It's quite possible that the system is not able to close that position in that 0.5%, right? What that means is that there are no buyers. So let's say liquidation was triggered when the price was 100. What that would mean is, and you were let's say you were long, price is falling, liquidation was triggered at price 100, your bankruptcy was 99.5. System will try to close it with $0.50. If it's not able to close it, then it will have to bankrupt you. When it bankrupts you, what that means is at liquidation itself, your position is closed. When it bankrupts you, that means that there is no taker for your position anymore, which means that the guy in profit also needs to be closed to make sure that the net open interest is zero.
Yep, netted off.
Yeah. So let me, run over this once again.
Oh, I see. Yeah, because otherwise the house would have to take the difference, and that's huge amounts of risk that obviously nobody can take. So
So let's take a simple trade to understand this. Let's say that you entered something with on a contract with Dan. Let's say there's a commodity on which you say that, look, Jesse has kept $0.50, Dan has kept $0.50, you are long and Dan is short. If the price, both of you have kept $1, let's not keep up, let's say $1, price is $100. When the price goes below, then Jesse loses because he's long. When the price goes, higher, then Dan loses because he's short. Let's say the price starts to fall from 100 to 99. At that point, your $1 is completely gone because your losses are equal to $1 that you have kept, right? So that is your bankruptcy. That at the point where your equity is zero, and I am the exchange. So I keep a track of these prices. So if the price goes to 99.5, I know that, look, now I have to bankrupt Jesse. So I take over the position from you, and I, in the open order book, send a message that does anybody else want to take over this position, right? There is still some money left in it, and you can, take that position at 99.5, at 99 when the price is still 99.5, right?
So is that order going on the screen, or is that order going through some other system?
There is multiple ways to do this. You can send it on the screen. That is called open order book liquidations. You can also send it to liquidity providers that, look, there is there are some positions that are getting bankrupted, but they have some juice left into them. You can take over those positions and immediately register some profit.
Right? Yeah.
So it's like buying a distressed asset. It's very similar to, a house getting liquidated or any other distressed asset, any loan foreclosures or any similar concept.
Yeah.
There is some equity still left, but it's been taken over. Now, if nobody else, I've broadcasted this message that, look, there's a position which still has $0.50 in it. It's available at 99 when the price is 99.5. If nobody takes it, then I have no option but to close that position because net open interest has to be zero, right?
Yeah.
Now, this is what is called ADL. So in this case, Dan was short, Jesse was long, you were long, market price was falling, Dan was in profit, but your position got closed because there was nobody on the other side to take the position. And the net open interest has to be zero. Note that as an exchange, you are not playing, you don't have any open positions, right?
So now I'm angry because I've been closed out, even though I thought this commodity was going down another 10%.
Yeah.
I was asleep or I was doing something else. And then I come back to find out that the price has done what I thought and I've made very little money.
Your position has been closed, right? So you slept off, and then when you got up, you realized that the price is down by 2%, and you should have been. This was the payday, and you realize that you have an email saying that your position was closed at 99 because there was no counterparty to take. So your profit was $1 when the current price is say 96 or 90. So that's not a very good experience, right?
So okay, so where does so then explain if you I guess you're going to this, but how I get compensated maybe by the insurance fund or how that works.
So this is where the concept of insurance fund comes in. That look, what you do is you create a fund that will you can call it investor protection fund, you can call it insurance fund, you can call it whatever fund, but there is a pool of capital that takes this kind of positions if nobody else is taking and holds it till somebody else takes over. Maybe somebody was interested, but they did not get the message on time, or they took longer to react, right? So this is where insurance fund comes in. So exchange puts an insurance fund in place. Now, in the previous example, Jesse would have been closed at 99.5, so you are out of the equation. But Dan still has the position open, and insurance fund has now, taken the position, or is giving, some redemption to Dan. But note that insurance fund does not want to be a trading party against you, right? Because if the price goes to 105, then insurance fund is in profit. And the idea for the insurance fund was not to trade, because then it's a trading fund, right? So first question we need to ask is, how will the insurance fund get created? And the second question we need to ask is, what will insurance fund do with this position?
Yeah.
So,
Right.
so the basic question that I want to ask is, so this sounds reasonable, right? This seems like a reasonable market mechanism. Why are people so salty about what happened at Binance over the weekend? Is it just because is it just natural, like anyone who got ADL would naturally be salty, or is there, why are these people particularly salty and noisy over this?
Yes. So before that, let's establish these three terms and the connotations. Liquidations is bad. It's bad for everyone. For the system, for the party that is getting liquidated. Nobody likes to get liquidated. And even the counterparty would not want their other. They would want, like Dan would want you to have enough margin and not to get liquidated, right? ADL is bad because for you it doesn't matter, but for Dan it takes away the the trust from the market. It's not a bad experience. That was the payday. So ADL is also a thing, that's something that you want to avoid. But note that ADL is good in the sense that it helps maintain sanctity of the system. It helps you make sure that the net OI is zero. Because if Dan was left with a position with no counterparty, at some day he would have realized that, let's say the price is 80, let me close the position, and then he would have realized that he thought he had $20 of profit, but he did not have anything. So in that sense, ADL puts in discipline, but yeah, it's not a good experience. It's not, you are trading for to earn, your call was right, and you want to get paid. And though in terms of discipline, it's a good thing. It's not a good trader experience. Insurance fund, of course, helps prevent these experience. We'll come to details of it. And now, why were people so salty about ADLs happening with Binance? So the thing is, insurance fund had $21 million. Binance's insurance fund had $21 million, and still people got ADL. So the question was, if insurance fund was there to back any positions, then why did we get ADL? So that was the question.
So do you think you should exhaust the whole insurance
so
fund?
Now
before
the design of insurance fund.
That's right. The ratio, how it's weighted.
Yes.
Yeah.
So how do you create the insurance fund? Now there has to be a lot of thought that should go into these procedures. First thing is, and let's start from basics. How is insurance fund created? Is it something that is specific to crypto only? How is it debited? And up until what point will it get debited? So how is insurance fund created? Now, let's go back to the previous example. You got liquidated at 99.5. When system liquidated you, it was able to liquidate you in the open order book at 99.3, right? So
Yep.
System took a position from you which had $0.50 of equity. It was able to close that in the market with just 20 cents of slippage, and 30 cents was still left. That goes as a contribution to insurance fund. So all the liquidations that happen contribute to the size of insurance fund, right? That is why BitMEX's insurance fund is large, because now it's very easy to deduce that more the history, more the OI, more the more the event of liquidations, then the size of insurance fund is higher. You can also draw a corollary that if insurance fund is higher, it might actually mean that the system is able to liquidate your position properly, right? Assuming that there is no no fishy business going on, if system is able to liquidate people on time, it will get more and more contributions to insurance fund, and it's natural that insurance fund will grow over a period of time. if it's able to liquidate you. If market is liquid and it's always able to liquidate people with just 5-10 cents of slippage when it has 50 cents, then insurance fund will grow over time. I'm not saying this is what is happening or not what is happening at BitMEX. I'm just giving ways to think about things.
Yeah.
Now, how is insurance fund only idiosyncratic to crypto exchanges? No. This is there on every exchange. Even on CME, you have insurance fund. And those exchanges even have, see, this kind of situation can happen anywhere, right? There is no guarantee that price will go from 100 to 99 gradually. It can go from 100 to 60 immediately. It's a free market, right? Anything can happen, particularly in equity market where there's a gap risk. So market closes and then opens at the next day. Some event happened overnight, and the regime has changed. So it's quite possible. I mean, we recently saw these circuit breakers, right? 10%, 10%, 10%. Yep. By the time market opened between two actually, trading zones, the price difference was close to 20%. So even in traditional markets, you can have this. This is by nature, this is the way leverage trading works. This is by design. And their exchanges have mechanisms like they do full KYC of participants. They ask them to sign bonds. They don't directly deal with participants. They deal with trading members who are brokers, and then brokers deal with, clients. And then despite that, they have an insurance protection fund. I did a tweet some time back that CME's insurance protection fund was about $100 million. And, if nothing happens, let's say they made you sign everything, but still there was a default. You were a fund that was trading on huge leverage. I mean, things have happened in the past, right? LTCM or Barings Bank and multiple examples. So in those cases, there is a fund to protect the other party. Now, how is the insurance fund debited? So let's go and, let's go to that example of that we were doing where the price was 100. Now, let's say there are two contracts. Now, one contract which has a lot of traders, other contract which has much less traders and maybe much volatile price action. So you have Bitcoin and you have, say, Link, right? The trading in Bitcoin is probably 100 times of Link. The number of traders active in Bitcoin is probably 50 times of Link. So if there's a big position if there's an insurance fund that is there to guarantee or give a sense of comfort to the community that, look, positions will be honored and there's an insurance fund to protect you, and suddenly there's an event on Link, price goes double or price goes half. I'm using any altcoin because the volatility is much higher there. Then it's quite possible that, this insurance fund, which this contract, which has actually contributed much less to the insurance fund, bankrupts the entire insurance fund. So the first thing you want to do is divide insurance funds on contract basis, and Binance does that. So if you see their insurance fund on Bitcoin was about $21 million, on other coins it was different, and BitMEX also does that. Sometime back there was an incident on BitMEX where people got ADL'd, and there was a lot of talk of, if there's such a big insurance fund, how did we get ADL? And then I think Arthur came and explained, or somebody from BitMEX came and explained that, look, it is divided as per contracts.
Probably wasn't Arthur. He was probably on vacation.
So yes, they explained, and but they don't disclose how much, and I think that should be disclosed, because then participants know what is the insurance fund for this contract. Binance does disclose it. What they don't disclose is how much will a position be compensated for. So if you have a position, will it be that till the time insurance fund goes bankrupt, it will support the position? So let's say in our previous example, insurance fund is $50. You had taken a long position at price 100 with $1. Dan had taken a short position with price 100 by keeping $1 as margin, right? The price starts to fall. Let's say the price is $20. Now, Dan, let's say the price is $80. Now, Dan has a profit of $20, right? Will the insurance fund, and you have been liquidated long time back, so will the insurance fund contribute the other $19?
Yeah.
And if yes, if that's the idea, then if the price is $30, meaning that Dan's payout is $70. What happens when the insurance fund is completely bankrupt? Right?
So
in this case, Dan has to be ADL because there's no money left in the insurance fund.
To me, this seems like,
yeah,
sorry, I was going to say, this sounds like a key input. Like if I was, some sort of arbitrage trader, high frequency trader, or whatever that was using using derivatives platforms aggressively, and I had to report to my boss my P&L, like I would really want to know these numbers, and how do I even make these calculations? Like it seems like people should know these numbers, right?
So okay, when we talk about mature markets, you would have often, you would have often heard fund managers talk about liquidity risk. That my position is $100 million, and the liquidity on XYZ stock that I'm trading is the $200 million on a daily basis. Which means that if I exit the stock, if I never want to be more than 20% of average daily volume, then it will take me 5 days to exit. And in 5 days, the price can move too much, right? So yes, when you have large positions, you have to worry about these things. When you have smaller positions, you don't really need to worry about these things. But at any time, I think you should know how much is the maximum, that you can get contributed for, and the exchange should clearly define that. So before coming to how do you choose that number, let's first define, let's go back to the previous example. If the price falls from 100 to 30, insurance fund is $50. Dan's payout should be $70, but it's only $50 because the insurance fund in itself has got bankrupted. Now, what that has done is that one trader took away the entire insurance fund, and that made the market non-tradable for other traders as well, right? Because going forward, that will introduce a lot of risk for a lot of other traders. B, this insurance fund would have accumulated over a longer period of time, and one incident was, was basically more than enough to kind of destroy the complete insurance fund. See, why did the price go from 100 to 30 so fast? And then if the volatility is so high, then should the exchange have kept more margin in the first place? So all these questions start to come into picture. And but the most important question here is that any such behavior will invite a lot of bad actors to basically come and try this more often than not. See, what was Dan's risk? He risked $1, right? Worst case, he would have gotten liquidated, but he can bankrupt the entire insurance fund, which has $50. At the times when he knows that markets are thin, there are not a lot of people trading, the volumes are slim, and the open interest is if he tends to become good part of the open interest. So remember, we had something like this happening in March of 2019. When a lot of people said there was an attack on BitMEX insurance fund, and price collapsed on Bitstamp from $7,000 to $1,000 pretty quickly.
Yeah, and it was like a $5 million print. It was something not very big, but it had a significant impact on the market.
On the futures. So yes, this is something that is very critical. How much insurance every party can claim to a maximum. Think of it. Like, I'll give another example to be able to relate to this easily. Let's say you are an insurance company, and let's say you are insuring all the houses against in Taiwan for any kind of natural disaster. Now let's say there is let's not take Taiwan, let's say some other place, XYZ place. Let's say there is some unfortunate event, some tsunami, some flood. Now the correlation risk in that time is really high. If you were insuring all the houses, you are going to have bankruptcies on all those houses together, right? You are going to have claims on all those houses together, right?
Yeah.
So one of the things insurance providers are very careful of doing is factor in the correlation risk. That look, if you are insuring farmers, and if there is a bad season, all the farmers are going to come and claim the insurance at the same time, right? When you're doing life insurance, you are not, what you assume is that there's a certain death rate in the country, and let's say that is 2%. So 2 out of 100 people will come and claim insurance. If you're charging half a dollar from every person, then you have $50 as a reserve. And if your maximum claim that you're giving is $10, So then 2 people come, so maximum drawdown is $20. So at any time you have enough cushion left in the insurance fund. So think of scenarios, equity markets crypto markets and any other markets are very similar scenarios. When these events happen, the chances of correlation risk or a lot of people trading that will come to claim insurance is really high. So let's put that, take one more step further. Let's say you were trading and you had a big position and you were at a very high leverage, and instead of that you had 10 traders against you, right? When you go bankrupt, all 10 of them will come and claim losses from insurance fund. So if each of them is claiming $2 loss, price is 98, you got liquidated at 99.5, then insurance fund is obligated to pay $20 in total, right? The size of insurance fund was only $50. So then if there is one trader who, let's say the price now moves $5 and then you have 10 traders, so the claim of all the traders put together is $50, right? So how do you divide? All these traders would have entered against you at different price. Not only that, they would have taken the position against you at different leverage. So how do you decide which one to give more money and which one to give less money and so on? So at some point, despite having insurance fund, you will have to ADL people. And you will have to say that insurance fund is, say $50, but your claim will be to a maximum of, certain dollar amount. Let's call it $5. Why am I taking a number like $5? Because all the bankrupted parties were keeping 0.5%, let's say about 10 times of that. Okay. So each person can get about 10 times of that. And that should be enough room for the insurance fund to take over the position, shout out in the order book that, look, here is a position that has $5 of equity in it. I am bankrupting it at 90 when the price is, I'm bankrupting it at 95 when the price is 97. So there should be takers available for this. So the broader point is that every trader will have a maximum level of compensation that they can get from an insurance fund. And that should be clearly indicated when you are talking about the design of insurance fund. Why is that? Because there is a correlation risk, and also otherwise it will invite bad actors to bankrupt the insurance fund. And thirdly, how do you distribute amongst different parties then? And that percentage for Delta Exchange is 5% in case of Bitcoin, and 2% for other smaller altcoins. And when liquidity increases, fund size increases, we keep gradually increasing that number. So practically, it never comes into picture. Now, we'll come to the specific case on Binance in a bit, but yeah, this was the dynamics of insurance fund and how much maximum redemption. How do you think about how much maximum redemption you have to give to a particular trader? Let's say there are 10 traders. There's a $5 loss, for each trader, which was the maximum they could claim from insurance fund. Now all of them have come and started to claim those losses. Then again, you have to, make choices on whom do you ADL first and whom do you, let's say all of them are close to 4.5. Then you have to make a choice. Whom do you ADL first and whom do you ADL later? And then you have the idea of who has more profit and who has higher leverage. Those who have more profit will be delevered first. Why? Because that's to easily think about it. Think about the concept of socializing losses. Those who are in profit, at least they'll feel they'll also feel bad, but they'll feel, those who are in loss, if they get ADL, that's a much more bad experience than ADLing people who are in profit. And again, those who are on higher leverage, are taking more risk. So they stand first in the line to get delevered as compared to those who are at lower leverage. So these two inputs go into creating rankings for insurance fund and not insurance fund, for ADL, as in who is going to be ADL.
And how do you know?
Is this a difficult thing to hard code into your system? It sounds difficult, or is it not?
No, it's not at all. It's a rather straightforward thing to build, and it's more about getting the theoretical construct around these things. in
It
place.
just sounds like the system is doing like a million things in
But
every millisecond. The complexity is just
the thing,
beyond
right? Yes.
comprehension.
So yes, that is where the importance of technology comes in derivative exchanges, and that is why the complexity increases multifold when you go from a spot exchange to a derivative exchange, because spot exchange is a transaction that happens and there is no bearing of that transaction in future, right?
Yeah.
You buy, I sell, we both take our assets, and basically it's always an exchange. It's exchange of fiat to an asset, exchange of asset to another asset, and that's it. That's a simple transaction. Nothing happens in the future. But when you come to derivatives, you have to make sure that all the longs are equal to shorts at any time. Those who get liquidated are closed out very quickly. Those who have to be ADL have to be ADL, because it's a very you have to maintain the sanctity of the system. What is the contribution of insurance fund in real time? And you have to build all this in your system. There's a very important variable that we have not spoken about here, and that is the velocity of price. Yeah, the price is going from 100 to 99.5. Let's say it is going in gradients of 0.1, but your system takes a lot longer to respond to it, right? That means that your mark price, which should be responding a lot faster, sees units a lot slower. So it goes from 100 to 99.6 to 99.2 and so on. What that would mean is that it goes from 99.100 to 99.6. It did not see you as a party that should have been liquidated. It goes to 99.2. It sees you as a party that should have been liquidated and now is very close to its bankruptcy. So when these things happen, when your systems become slow and when your API is not fast enough, when basically there's a lot of lag, then the whole thing will start to explode, because those who should have been bankrupted early were not bankrupted. And I think this is what triggered all the issues at Binance, in this incident, because the price movement was same for all exchanges. There was no ADL on BitMEX, there was no ADL on Delta, there was no ADL on Deribit, there was no ADL on any other derivative exchange. There were ADLs on Binance. All of Delta, BitMEX, Deribit all have insurance funds. Binance has insurance fund. What happened at Binance? And my guess is that the granularity with which they were able to see the price, by the time they realized that the price has already gone so lower, it was already beyond the bankruptcy that insurance fund was willing to guarantee. So let's
they're
say
back footed. They're trying to catch up.
Yeah. So let's say the price goes from 100 to 98, but you see the price at 98 immediately after 100. Then you don't have any option, and let's say you have only allowed 1% to contribute from insurance fund. What that would do is it will not allow the system any time to broadcast positions in open market. The system will immediately see you as bankrupt, see the insurance fund has already made the maximum contribution, and it will look to close out Dan's position. Whereas what it should have done, it should have taken the position, look to bankrupt it in open market, or look to bankrupt it with backstop liquidity providers or any other liquidity providers. So that is where Dan's point of speed becomes super important. Derivative exchanges are all about speed and not of the speed of matching. Speed of matching is very easy. Transactions per second is not the metric you have to be looking for. You have to be looking for risk checks per second. So all the TPS thing we heard back in 2017, what's the TPS of your exchange? It's a very, TPS can be 10 raised to power 6 per second, doesn't matter. You can do 10 million, you can do 1 million matches per second. What you really need to do is risk checks between two price changes.
So for an exchange like Delta, you start off, when you start an exchange, you start off small, it grows organically, and you scale your system, over time. Is Pankaj still there, or is he gone?
Yeah,
I thought this was a question for. I thought this was a question for me. Sorry.
So you scale over time, and that allows you to, over time, feel more comfortable with bigger volume and more confidence that your system can take the load. Now, now with, let's say, Binance, that went from doing no futures volume to doing billions of dollars in futures
Yes.
volume in a very short period of time.
Allegedly.
How could they? Let's not make a decision around, or let's not even discuss how you go from doing zero to billions of dollars. That's one question, but it's not one for today. But did they buy an existing platform that was already so robust that they were so confident that they could put that type of volume through without having issues, or were they like you? They built a platform that they didn't have a clue and just wing it?
That's not what Pankaj did.
So yeah, we had all the ideas very sorted down. So
how did they start that?
So, okay, couple of things here. When you start an exchange, or when you start, like I explained, right, that insurance fund builds over a period of time. So
Yeah.
on day one, if there is no trading history, there will be no insurance fund. So what does the exchange do? Exchange takes some of its own money and puts it in the insurance fund,
Yeah.
right? So you put, say, whatever amount of money into insurance fund, you seed the fund, and then it grows over a period of time. That's a very simple operation. There's nothing to go into detail with it. Now, how did their insurance fund come up to a certain level on inception? I think they would have seeded it, which is very fair. We have also seeded our own fund. And then over a period, so you get that initial seed, and then it grows over a period of time, or it comes off, grows, whatever trajectory it follows depending on market conditions.
Yeah, but seeding your insurance fund is not the same as having confidence in your systems, is it?
So okay, now then it comes to building the systems, right?
If Delta opened a new exchange and you raised enough money that you could put $50 million into the insurance fund, that still doesn't necessarily mean that you're
Yes.
confident that you could be trading $5 billion on the platform.
And clearly, right, they had 21 million in the insurance fund, and the market moved by what, 10%? I mean, in cryptos, market moves a lot more, right? Market can move a lot more. And B, the speed at which market went, yes, it was fast, but it's not like we haven't seen faster speed before. I think even on Black Thursday, we had markets were moving a lot faster. So look, I think it's more of a technical issue at their end, and in these kind of scenarios, see, the way margining works in cryptos is very different to the way margining works in traditional exchanges, and this is pretty interesting too. So let's say a traditional exchange, let's say you're building a traditional equity exchange that has circuit breakers in place, right? So what a typical circuit breaker would do is it would say that I would not allow the price to move more than 10% during a trading day, right? So when, let's go back to our example. Jesse and you are trading on a certain exchange. Price is 100 of a certain commodity. On this exchange is called, traditional stock exchange, TSE. And then TSE says the margin requirement for every participant is $15. So each of you kept $15 with the exchange as margin. And then it also says that they will not let the price move by more than $10 during a trading day, which is 10%, right? At the market close, you will again get a margin call if there is not enough, let's say $15 was the initial margin and $10 was the maintenance margin. So anytime you are less than $10, you will have to bring it up to $15 again. So there is no reason for the exchange to do an intraday risk check, right? During the day, if the price at the beginning of the day was 100 and now it can only go between 90 and 110, neither of you can be bankrupted, right? And at the end of the day, exchange can give you a call and tell you that, look, you are, price is 110. Dan is about to get bankrupted on a short position which was initiated at 100. Either you bring the position back to, either you put $10 more of margin in it, or which is the loss for today, or they will close the position tomorrow morning, and that gives enough time for you to react. That gives enough time for exchange to react without doing an intraday risk check.
Yeah.
Now that is how a lot of exchanges work, and so they can work on a simple model that, look, we build our margining separately. Once the exchange opens, it works like it doesn't matter. We assume that every party has enough money to play with, and there is no reason for us to do risk checks. So we are going to do a transaction per second kind of a thing. That look, all it we need to do is matching during the day. So you can pretty much take the same code as a spot exchange and run it with slight tweaks here and there. But in cryptos, it works very differently. Because here what we are doing is price goes from 100 to 99.9, we do a risk check again. Price goes from 99.6 to 99.5, we do a risk check again in the real time, and we say that, Jesse needs to be liquidated, act now, right? There is no market opening, market closing. It's a 24/7 market, and there is no circuit breakers. So there is no break. So it's a true free market in that regard. It has a very high volatility, and it has been trained to, or at least people in this ecosystem, players like us, have been forced to innovate and come up with robust solutions to basically support very high leverage for these highly volatile asset classes. All derivative exchanges have done that, right? For us, we have gone one step further because we also do altcoins along with Bitcoin, right? So we have them on the same wallet. So you can bring stable coin or Bitcoin and trade, say, 30 coins. Now, when you're trading so many assets, whatever we discussed right now was for just one asset. Imagine that your account is being checked for 30 different assets, and wherever you are in liquidation, you have a problem. So, and imagine that you are doing this for every customer. As your customers scale, and as your volume scale, as your number of coins scale, your complexity will scale multifold. So you have to build your systems such that your complexity does not scale as your customers' volumes and contracts grow. Your complexity remains the same. And that is where the whole innovation on technology goes. And that is where we have spent a lot of time building a solid and a robust trading engine. We can support about 100, at least 100 coins easily on our systems with a very high leverage. And we have about 30 live as of now. We are very confident of running 100 coins. Our systems are built to be able to respond fast in any kind of situation, and we've used we've designed architecture in that fashion. We've used language which supports such high speed. So all these things go into building a system that is robust. And I think this is where it is very difficult to buy a trading engine. So Dan, what you were saying, that did they just buy a system from somewhere else and put it in and try to do a 2 billion type of volume or whatever they are doing on top of it? So this is where this is not a problem you can solve with you can solve it with money, but it's a problem that needs time to solve. So this is where you need to spend a lot of time building a system that can take that can respond to these kind of curveballs.
So what do you call this risk? Like, is this like platform risk, execution risk, counterparty risk, and how does a user mitigate this? Like, how do you go and evaluate? Should I be using FTX? Should I be using Delta? Should I be using Binance, Kraken? What questions should I be asking?
This is platform risk. Particularly an incident like you had insurance fund. You had an insurance fund which technically does not have seem to have any limit on how much will it redeem every party, but still you have cases of ADLs, and in a market that was not moving so fast. So it seems like a case of technology issue, and that would mean a platform issue. So it's the same kind of thing that happened on BtMEX, that the overload problems, that they also do risk checks in real time, and once you have more than, they have about 5 or 8 contracts as of now, and they haven't launched a new contract in terms of underlying for about 18 months now, new underlying. So they recently came out with the Ethereum fixed maturity future, which is a Conto, ETH USD Conto, Bitcoin Conto. But they haven't come up with a new underlying for the longest time. That is because your systems don't scale that easily. So this is in my opinion, clearly a platform risk, and that is where executing on a platform like Delta, you won't have any challenges. We did not have any ADLs on that day. Look, like I explained, any platform can have it. Technically, for a theoretical discussion, even traditional exchanges can have it. The way it needs to be looked at is, was that move something where you should have had ADL? Was that such a big move? I mean, that was a 10% move. That was fast, but not that fast. So on that day, should you have had ADL? And if you're having ADL on that day, that only shows that there was some latency in the systems.
Why were there ADLs on that day for Binance, but we didn't hear of any ADLs back in March on a bigger move?
Yeah, that is
I guess that's your point, right?
Yeah, that is something even I'm not sure about. But I think they've launched a lot more contracts since then. So maybe the systems, are
more complex.
having
complexity.
The complexity increases. But yeah, that is something that I'm also curious about. What changed? My guesses would be above. Also, I'm not sure. Maybe that day everyone had some incidences of ADL.
That's what I was going to say too.
Probably it did not flag out. It did not stand out.
Yeah.
So I remember that day, a lot of platforms had ADL. So
Dan, I think you had a question.
Yeah. As I was just saying, if I wanted to start a crypto spot exchange today, you can find lots of off-the-shelf solutions. You can do white labeling with Binance now. You can do them, but you could. There's loads of them out there, right? Yeah. Is there a similar thing in the futures markets or not?
So if you want to start a spot exchange, there is free open source code available on GitHub. You can just pick it up and build it on your own, or you can take it from any of the bigger spot exchanges like OKX and Huobi and Binance and white label. I think these guys will try to do the same thing when it comes to.
So Binance doesn't white label their futures business yet. They only white label the spot market.
I don't think so. I think futures business for them is still quite new, and like we have seen, they are still coming up the curve, and there are still some stability issues there. Purely basing it off this incidents and one or two incidents that have happened in the past and in public domain. But yeah, I don't think they white label their solution as of yet, and then that will happen in the future. But I think technology is quite important when it comes to derivative exchanges and building a robust derivative exchange.
And then the other question was, it's kind of a tangent, something new here, but so with JP Morgan allegedly banking, a couple of large custodians, there's
allegedly a chance. It's a good thing that they're banking.
I mean, who knows, right? I mean, they come out tomorrow that they're not banking them and they never will.
Trust, but verify.
Yeah. So let's just say they are, and let's just say that a lot of other banks get FOMO, and suddenly, banking is no longer a problem for people in this space. Does that change? At the moment, Delta doesn't offer any fiat options, but would that change the environment? I mean, at the moment, having solid bank relationships is a bit of what's it called? A
pain in the ass.
Well, no, but if you have them, it's a competitive advantage. Because it's very hard to find, particularly in the spot market. It's very hard to find. But if you have a solid one and they don't put silly limits on you, it's a very big competitive advantage. And actually, it's often how exchanges are looking for other targets they'll often move into a market and acquire another exchange because they know that they can't replicate what that exchange is doing. Now, if the environment changes where suddenly banks are very open to this, two things happen. One is, there is no more premium for exchanges that had banking relationships that were solid, because now anyone can get them. But two, does it change your outlook in terms of your willingness to support fiat pairs or not?
So let's take these questions one by one. I think JP Morgan banking Coinbase and Gemini is a very good move for the industry overall. Definitely, if that was anybody's competitive advantage, having a banking relation, that will go down, which is very natural and a good thing actually, because what this does is it sends signal to a lot of other banks that look, these guys are looking at crypto as an industry. See, nobody comes out and does things unless they see good future in it, right? So if JP Morgan is willing to bank these players, there are multiple things that exist. A, they are comfortable with this industry now. B, they see huge potential in this industry, and C, they must be seeing a lot of comfort from the regulators side, because these guys are the top tier banks, and they have a lot more closer relationship with regulators. And they are on regulators' eye much before smaller bankers. So
This industry, as it stands today, still wouldn't move the needle for JP Morgan. So I think what you've said there is one of the biggest points of this, is that if they are getting involved here, they think this is going to grow 100,
yes.
1,000 times, not 10 times, because 10 times still wouldn't move the needle for JP Morgan. It'd still be meaningless.
Yeah, and unless they see huge potential, they won't come in. And remember, we had a chat about a year back or so where we were talking about institutions in cryptos, and I said there are hardly any institutions in cryptos, and there is proprietary money, but there's very little institution money. I think that is changing very fast, and there are a lot of signals out there. So you see Paul Tudor Jones, his letter to his investors. So that is responsible investing, right? And when you're comfortable talking to your investors about it, and when it's also sending a signal to a lot of other hedge funds that you will not be, if you're investing in Bitcoin, then you're not going to be seen as the only one, and taking
reputational risk.
Yeah, reputational risk for doing that kind of business. JP Morgan banking these guys. These are big strategic movers for the industry. It will send a big positive signal to a lot of institutions that JP Morgan is comfortable with Bitcoin space now, the way they would look at it as a crypto space. So these guys are now comfortable with it. So let us think of investing in this space. So, and think of it, how that will send signal to, let's say, a country like India, where RBI has already come out and said that banks can do business with crypto companies. Or banks should be allowed to do business with crypto companies. And Supreme Court has come out and said that banks should be allowed to do business with crypto companies. And RBI is still, hawkish on that. So it will send a big signal to people working in the banks and in the top banks in the country, going to RBI and telling them that, look, this might be a big industry. It looks like a lot of other people are coming into it. We should also look at this. Everybody wants business, and particularly in this kind of environment, right?
That's a really good point, because I had a lot of interactions in my previous position with regulators in Taiwan, and that is literally one of the first questions that they'll ask is, what are the Americans doing? What are American regulators doing? What are the big banks doing? And nobody wants to be the first mover, right? They're all very scared of that, right? So they want to have precedents that they can point to, and that is a big deal for companies all around the world when they're interacting with their regulators.
So that's usually with these things, right? When they kick in, they take a long time to kick in. But once they have kicked in, there's a big FOMO. So remember 2002 when investing in Asia became a theme. First, very few people were investing, but by the time 2004-5, if you were not investing in Asia, you did not know much about fund management. So
I was so excited. I moved to Asia in 2002.
I've heard that called as the golden age of sales trading.
It was.
Yes.
Yeah. We were making
and
18% on some commissions. 18%. Who makes 18% on a commission trade now?
Yeah. Not even anyone in crypto.
No, crypto's already at 18 basis points.
Yeah,
or
no
lower,
kidding, man.
Or 8.
Commission compression happens so fast in this industry. It's just...
Yes.
Not only does the industry move quick, but so do the rates.
Yeah, we had like 20 years of commission compression in 2 years.
Yeah. Everything in this industry will be a lot faster.
Yeah.
So
Except the fucking
historically,
price. Sorry.
yes, but the even a very good example of how themes play out very fast is Corona crisis, right? We
Yeah.
fell very fast. Central banks reacted very fast. We recovered very fast, and everything
Yeah.
is just the comfort that people have with how earnings are going to be in the June quarter and everything. It seems like a lot of people have kind of digested the shock in terms of markets, not in terms of real economy, but market and expectation of how the numbers are going to be. So yeah,
They're
you
wrong.
know, it's been a lot
They're very,
compressed
very,
as
very,
compared to other
very wrong.
crises.
They're all going to.
Okay.
I'm just saying. I think they're very wrong. Like, it's amazing how many very seasoned, very experienced macro. I mean, there was a macro guy. I don't want to mention his name just because I actually really like him. But he put a tweet out the other day saying, if you want to understand why markets are going up, just take a look at some of the queues outside the restaurants that are reopening, and this is in America, right? And then that was it. That was the tweet. And I just look at that tweet and I just think that's a very, I don't know, it almost feels like someone who's not aware of what's actually happening with this virus, as in,
But like 20% unemployment and.
Well, no, it also makes me think that, well, the chances of having a second wave that is 10 times as big as the first wave, because after a few weeks, you're already seeing huge lines of people going into restaurants and not wearing masks and not doing anything different. Just raises the risk that there's going to be a second wave of infections that's going to be 10 times as big, that really will close or break the hospital system. And then we'll require another lockdown that's going to require another $10 trillion of balance sheet to be. So for me, when I see 500 people queuing up outside a restaurant in America wearing no masks, I just think I'd happily short the hell out of the markets. It's not a positive sign to me. It's a very, very, very bad sign.
But do you think that's the norm, or do you think that's just one, or
I don't know. I mean,
example?
I think there's enough states. I don't know. I don't want to get too political, but I think the Second Amendment and the right. There's this feeling of always protesting your civil liberties, and wearing a mask is somehow infringing on that. So there's always there's so many states that just seem to be protesting for the right to do what they want when they want, ignoring any of the advice, which I can understand, because listening to the stuff that's coming out of the American mainstream from the White House, it's all over the place. It's pretty poor quality. I mean, if you compare it to, say, something that's coming out of Taiwan, where our vice president is an epidemiologist, and the country has done exceptionally well at containing the virus. So I don't know. My point is, I don't feel at ease watching what I'm seeing in America. I think the worst is yet to come, and it's going to be much, much worse.
Well, so I was going to shift gears back to futures markets. We had a good conversation before this about Dan, you mentioned about volatility in markets. Like, are the growth of crypto exchanges making our markets more or less volatile? And Pankaj had a different opinion than I think I do on that, right? Like, you had one point there that maybe we could dig into, because I thought it was an interesting one. Like, you said you thought we could have got. I thought the drop to 3,800.
What are they supposed to do as well? What are they supposed to do versus what are they doing? Yeah.
Well, So before we dig into that, I just want to say that the thing that we were talking about, that I think the price dropped to 3,800 because of the futures exchanges, right? I don't think anybody willingly sold their Bitcoin at 3,800. And I think Pankaj disagrees. He thinks we would have gone there anyway. So can we? I mean, there's a lot of questions there, but pick one.
So we would have gone there. Okay, what do derivative exchanges do? They provide a way for people to short, right? And there was a big open interest, and we fell into this liquidation spiral that there were not enough bids, market was falling, and there was no way to arrest that fall. We were continuously liquidating, and those liquidations were further creating pressure on market. But see the amount of selling that was happening on spot exchanges. The fall started with spot exchanges. and leverage. So what you are doing on futures exchanges with liquidating is killing the leverage, right? All the levered positions are going into liquidations. But there was a lot of leverage in the system, even outside of derivative exchanges. I mean, when you stop selling Bitcoin into halving as a miner, start hoarding it, and then pledge those Bitcoins to use, to get USDC or USDT or
And fund
dollar out of it.
capex. Yeah.
Yeah, and fund
Betting
capex,
that the
and
Bitcoin price will go up and then it doesn't. Yeah.
yeah, and look to mine even more because you have a belief of a positive trajectory. Then you're basically taking risk. You don't have any sales because you haven't sold the output yet or the produce yet. You have costs and you're increasing those costs to increase the yield. So it's like a farmer, who's filling the godowns with all the wheat that they are producing, and then suddenly there is a fire at the warehouse. All the produce goes away, and that is then you have a big bankruptcy because those who have kept this produce as collateral, they are going to try and fire sale it. So yeah, nothing would have stopped people from, or miners. Actually, that happened on with Bitcoin. So a lot of miners were actually borrowing against Bitcoin,
Yeah.
and those a bunch of that collateral was kept on spot exchanges, and a bunch of that collateral would have been with OTC desks and those who so all the lending platforms. Lending is a great thing for an asset class. It creates matches demand with supply. Again, the same thing can happen there. I mean, let's say you don't have derivative exchanges, but you have a big lender who's giving you dollars against your Bitcoin. And if those Bitcoins start to fall in value as collateral, they have no option but to liquidate your Bitcoin. So in that regard, I think you cannot really stop that dynamics. It is going to play out one way or another through derivative exchanges, through margin trading, through lending businesses. I mean, the only thing that you can do is basically put a ban on selling, and that is never a good thing. And you know what? There's a very good recent example for this. So look at Sri Lanka Stock Exchange, Colombo Stock Exchange, right?
Mhm.
It
I've never
was
done that. I've never
closed
looked at that before.
on, so it closed operations on March 25th, I think, and opened 2 days back after 55 days later. And there was no April, so there was no, market collapse and everything. And it opened on Monday, I think, and it opened with a limit down, right? So their
Mhm.
idea was that if we don't allow people to sell, the prices won't go down. So, there is no exchange,
Brilliant.
there is no shorting, there is no selling. That's it. Price cannot go down. But the thing
Genius.
is, when it opens up a lot lower. Now, look
Yeah.
at every other market. Between that time and today, every market has gone down and has recovered. Bitcoin is actually higher than where it was on Black Thursday, right? At least was higher 3 days back. So every other market has recovered, has seen the pain, has gone through it. If you don't allow trading, that does not mean the asset is not going to fall in a black market or in some other market. People will want to offload risk, not because to your point that nobody would have sold their Bitcoin at that price. The thing is, they would have because it's quite possible that they needed money for something else.
Yeah.
Maybe they
Yeah. No,
did not want
that's a
to
good
sell.
point. Yeah.
They would have. Yeah.
You
So
know, how much trouble are those poor miners in? Like, think if you're some miner in
oh
China,
yeah,
you lent out your Bitcoin to get USDT, you capex like crazy. Somehow you survived that drop to 3,800. You sold your wife's house and the car and all that stuff. You made it through. And now hash rate is still persistently high after the halving. Like, these guys can't catch a
no, but
break
you
over
have
there.
to factor in. It's more trouble than that because they would not have been able to. A lot of them, would have had troubles with their operations in February and January. So they would have been thinking that the price rise would save them in March
Yep.
and April, right? Because they've thought that crisis is already played out. If you are in China, you were seeing the crisis in Jan-Feb. Global markets were not reacting to it. Bitcoin was not reacting to
Yeah.
it as much. So you would have thought that the crisis is played out, and you were happy to be levered, hoping that the price would go up in halving. When you have done capex, but you're not able to use it, and you are running inefficiencies because of lockdowns. and suddenly there's a huge crash. So it's even worse. And now, hash rates have gone up. I'm not sure if supply chains are back online for people, supply chains are functioning without any bottleneck for people to be able to buy new hardware. So there are a lot
Another
of
question.
angles to this.
Just, I don't think you answered the question about whether you would ever offer fiat pairs. Did you, or did you answer that?
No, I did not.
Oh,
So yes, we are considering fiat. So yeah, on that point, we were on that point of JP Morgan. I think it's a very good thing for the industry. I think what it will do is it will have bankers. Two more big banks come out and say they are banking cryptos. It will have all the small banks chasing crypto companies for opening banking relationships. So they will start to see this as a new business opportunity. Central banks will be a lot more reluctant because, like you said, all the regulators ask you, what are Americans doing? So it's pretty much the same in every geography. And they would be more comfortable if other regulators are allowing this. Nobody wants to say no to business, particularly in a crisis environment, right?
Yep.
So fresh business is welcome as long as it's, there are good checks and balances. I don't know if that will completely eliminate the Bitcoin price premium. So India, Bitcoin trades at a premium. Korea, Bitcoin trades at a kimchi premium. That might still remain because that is more to do with capital controls. But yeah, that would definitely go down if more and more players come in the market.
and then
for us,
carry on.
For us, we are already thinking of integrating fiat, and we have been talking to partners. The first step for us is to integrate fiat using partners. So somebody who provides payment gateway, fiat to crypto gateway. We will look to connect to those guys, and basically customers won't feel the difference. They will pay money through a payment gateway, and it will get credited, or crypto will get credited to their wallets on Delta Exchange. But yeah, we might not be doing the getting directly liaising with banks. We might not have our own banking relationship. We might
so you go through some other third party that will facilitate it.
Yeah, it's a lot of overhead too. Then you've got all the KYC, you've got all the AML stuff, you've got the bank relationships, you've got all of that stuff to maintain. That's a lot of
and I think those players, that's a part of the industry that needs to grow because right now the premiums there are pretty high. So they are charging about 1.5% to 5%, anywhere between that. So
you watch that fall, just like market makers used to charge, so much money, and then that just collapsed. It'll fall like crazy, right?
Yeah. That's just a competition dynamics. Yes.
Me and Jesse were talking earlier about JP Morgan coin and how if JP Morgan is serious about this business, then when you tie in their recent announcement on banking the exchanges, then there's a possibility that JPM coin becomes the stable coin of most likely regulated exchanges institutions, because they could easily be which would be a huge threat to all the stable coins other than Tether. Tether's most likely remains dominant because it's still the preferred base pair for every exchange outside of the regulated environment. Yeah, it's the people's coin, right? But if you're USDC, then JP Morgan coin could be a huge threat. So the question I have is, over the next 2 or 3 years in this bull market, it's where do we think the growth's coming from? And we've been talking, I think, for a couple of years now, and that we think the growth is coming from institutions. And I think, institutions will probably be 10 times as bigger as the growth in retail. In terms of, if we look at actual dollars invested into crypto in the next 2 years, I think institutional growth will eclipse retail growth. Personally, I think retail growth might longer term eclipse institutions, but that's another story. So if that's true, then over the next 2 to 3 years, how does an exchange like Delta capitalize on that? Because at the moment you're working in an unregulated, I don't think you're in a regulated country.
No,
or
we
regulated
are in Caribbean where there's
jurisdiction.
very little regulation. Yeah.
So how that is actually, do you see that as a threat? Where's the opportunity to come out of that? Any thoughts?
So again, let's take these one by one. On JP Morgan coin, isn't USDC backed by Goldman Sachs as well?
Yeah, by Circle, who's got a small equity stake in Goldman, who has a small equity stake in Circle, yeah.
Yes. So, then there's a hook, right? So it's clearly on the radar. So I'm with you on the fact that USDT will remain pretty big, because once, think of all the stable coins at startups, and once a startup is big enough, like Uber or others, then it's very difficult for even the institutional players to come and take it out, right? So they just have a lot more robust systems in place in terms of business partners, suppliers, pipelines, placements, all these things.
I don't
So
think
I think
JP Morgan coin will. I was going to say, I don't think JP Morgan coin will be pitching in China either. So
yeah, and look at the way XAUT has been a success, right? The way the market cap has increased on that. That is because of all the relationships that would have been built when placing Tether, right? So USDT. So again, you just use the same distribution and plow a different product in those pipes. So it's a lot more easier. I'm not sure on how, if these investment banks will go on a battle with one another regarding the stablecoin. But yeah, it's going to be an interesting space with central bank digital currency and Libra. And I think talks on Libra will start to heat up again in some time. And then stable coins with investment banks. So, but I think it's quite possible that few of them join hands to put another couple of 100 million in USDC. I'm not sure what happens. It's all speculation. Now coming to where is the next leg of growth going to come from? So when we started to talk about institution back in 2017, before that, it was not like institution will come. It was like retail is already there. Institution will also come in now, as in the asset class is becoming important enough for institution to participate as well. Now, again, it's the same thing. When institution participates, then it's not like retail is going to get left behind. At the end of the day, it's still very under-penetrated asset class. So there'll be multiple levels at which participation will open up. Right now there is only a handful of people who even view it in the consideration set. I think that will change. So, and institutions will have to, there'll be many different things. They are very country specific. They are very fund specific. They have a different structure. They have liquidity constraints. So it's not like, it will be more accretive than it's bad for any player. Everyone who is in the space will do well, in my opinion, because of that happening. And to a certain extent, I think that's already happening. Look at the way OI in CME has started to pick up, right? And look at the announcement from Tudor about Bitcoin futures. So I think at this point in time, more and more institutions are looking to play Bitcoin in futures rather than in spot. And I think that is one of the big themes that is in play at this point in time, because futures have a lot less, paperwork and compliance to do when versus buying in spot. Buying in spot, you will have to figure out all the procedures that are set, all the funds that invest in Bitcoin. Where are you going to put your money? Which fund are you going to put your money with? Can you directly buy Bitcoin? If yes, how will you custody it? When you're managing big money, there's a process for everything. Right? Whereas with futures, it's cash settled. There is not a lot of custody risk. You're already doing business with CME. All the insurance fund and all these things are taking care of it. CME. Yes, the leverage is very low, but look, you would have, it's an asset class that is running pretty strong. So I think they have now 450 million worth of open interest. I think institutions coming in is already at play to a certain extent, and I think it will only accelerate in the next 12 to 18 months. And this is more of a virtuous cycle thing, where one thing will push another, and then institution volumes will push retail will push other retail, and that will push more institutions because prices going up, more and more funds come into play. So it's going to be good for everyone, and certainly for a player like us who already has an advantage in terms of having a robust platform, being able to offer a bunch of products that are not offered on other exchanges, because when market risk appetite is higher, you have willingness to try a lot more things, right? When previous rally of Bitcoin was going on, people were willing to give a chance to every other small altcoin. So this time around, we are also going to see that a lot more products come in, a lot more companies come in, players like us thrive, and
and you have the option, that optionality built in of a country that of 1.2 billion people that
yes,
so that couldn't really trade, but it's now becoming more
yeah. And think of it, what is it going to unlock? So National Stock Exchange of India is the most liquid derivative exchange globally. It is more liquid than CME. There's a Bloomberg piece on it in January 2020 this year that NSE now is the biggest derivative exchange globally. It has more number of contracts traded than any other exchange. So all these traditional market players who are trading Nifty futures, who are trading single stock futures. In fact, India is one of the biggest single stock futures market, and that is why borrow markets in India never grew, because the single stock futures market were thriving. So there was no real reason for people to go and have a very strong borrow market. They could short and long in futures itself. So when all these players see these juicy opportunities on Bitcoin and everyone else trading Bitcoin and all the JP Morgans of the world setting up funds to trade Bitcoin or doing business with Coinbase, they are also more open to trading Bitcoin and basically going long short Bitcoin, doing arbitrage on Bitcoin, extracting the cash future arbitrage on Bitcoin, doing put call parity trades on Bitcoin. All these are low risk trades. So there's a huge market in India which is of derivative traders, and that is because we just spoke about how this is one of the largest. This is the largest exchange when it comes to derivatives trading. That unlocks, and we are right here at the epicenter. We know this market, we understand these traders, we speak the language, we know what they're looking for. We can tie up with partners, provide them a fiat gateway through a partner. So yeah, it's just
getting
a lot
me excited
of
again.
for us. Yes, indeed. And let me give you another statistic. Single stock options in India is a $20 billion daily market, and about 80% of that was retail at one point. So huge numbers, and India is much smaller market when it comes to index future derivatives as compared to other markets, but huge when it comes to index options and single stock options and other products.
That's very exciting.
Boom.
So yes, there's we are pretty.
That's got to be a good note to end on, or are we not quite there yet?
I think it's been a longish conversation.
This might be a record. Yeah, I was going to say if anyone can watch this far into
the interview, gets to here,
I will send you 0.00001 BCH.
Did you guys see after Bitcoin halving, BCH and BSV hash rates went up again?
That's great. That's great.
Yeah. So, and it tells you that miners actually did move from Bitcoin Cash and BSV to Bitcoin in the last 30 days.
Yeah.
When the reward was higher on Bitcoin side.
Yeah, they had to. Yeah. All right, guys. That was great. Really interesting. And we'll have to do more of these.
Yeah, it should be good.